Investments to avoid if you are nearing or currently in retirement. Number one, high-cost mutual funds and ETFs. Now, these are investments. These types of investments come with high fees that can eat into your retirement savings, and they often underperform lower-cost alternatives, resulting in lower returns. Do you know your expense ratio? That's how much you are paying in fees for your investments. Now, folks, this is for clarification and for being honest and let y'all know, I don't do any stock market. We don't do anything at SMMG Financial. Nothing that we do is involved in the stock market. All right. I don't have my Series 6. I'm not FINRA licensed. Don't want to be. My philosophy is we've worked too hard to get where we are right now today. Whether you've been working 25 years or 35 years or 45 years, and if you've done a good job in your retirement fund accumulation, whether it be a 401k, a 403b, or an IRA, when you get close to retirement, remember that retirement red zone. We talk about it many times over the last couple of years on this show. That's the 5 to 10 years before you retire, the 5 to 10 years into retirement. When you get in that retirement red zone, folks, the key that you need to remember is not to lose. There are too many people across this country, across the state of Arkansas, that are trying to get to the point where you're at right now. So your number one objective is to make sure that you have your retirement funds in some type of a safe money program, safe money product where you will not lose. Okay. I'm not saying all of it, but you got to protect a significant portion of it, because the last thing you want to do, we spoke about it earlier in today's show, what happened in 2008. You don't want to get close to retirement, have everything in the risky investment, and boom, the bottom fall out, 30, 40% drop. Again, you're going to have to make some decisions. You're going to work longer, wait till it comes back up, or you're going to retire at a lot less income than you actually thought because your retirement account fell by 30, 40%. Okay. So that's one of the reasons that we kind of stay away from the stock market investments. We have to use safe money investments, and we can do another show on safe money investments. All right. How about cryptocurrency? A lot of you guys know about Bitcoin and all the other fancy, there's a lot of them out there. Okay. But cryptocurrency is highly volatile and unpredictable. Again, these are investments we feel like you should avoid if you're nearing or in retirement. So they're highly volatile and unpredictable, making it risky for retirees. Crypto lacks intrinsic value and can experience extreme price fluctuations. Just look at Bitcoin. Look at what it started out. Look at what it got up to a max. It kind of fluctuates back and forth. But the uncertain future of cryptocurrency makes it difficult to assess its long-term stability. So we think that you should avoid investing in cryptocurrency. High beta stocks. High beta stocks are more volatile than the overall market, posing a higher risk. Retirees may not have enough time to recover from significant losses in these types of stocks, much like the people who retired right before the 2008 financial crisis. That was a double whammy. You retired before the 2008 financial crisis. You started taking money out, even if you were using that 4% safe withdrawal number, and the market fell by 30 to 40%, you probably were not going to have enough retirement funds left to outlive them. In other words, your retirement fund's going to hit zero before your blood pressure does. All right. Okay. Low yield traditional savings accounts. Traditional bank savings accounts are after very low interest rates, resulting in minimal returns. All right. They offer very low interest rates. Now, some of the rates are a little bit better today because of the inflation. Okay. Because everything costs more. Treasury bonds are up. U.S. government bonds are up a little bit, and that's why they're offering a little bit more today than they were in the past. But a traditional low-yield savings account is not what I consider. I think you should always have some money on hand for emergencies, but that shouldn't be you should not look at a low yield traditional savings account as being part of your retirement funds. Just put it in there. If that's what you've got to utilize it as your emergency account. All right. You can have access to it very quickly. Physical gold and silver. I get asked about this all the time. Physical gold and silver can be illiquid and difficult to convert into cash quickly. Storage and security costs associated with physical metals can eat into your returns, and storing precious metals in your home doesn't help with peace of mind. All right. I'd hate to know that you had $100,000 in gold coins or bullion or silver or whatever it might be, and you had it stuck in your closet. Somebody finds out about it. May not be the safest. Folks, listen. If you've ever checked into silver or gold, a lot of people look at that. They're going to charge you a premium when you buy it. And if you try to sell it, they're not going to give you what it may show you that gold per ounce. I don't know what gold per ounce is right now. It may be well over $2,000. That's great. But if you call somebody that deals in gold, they're not going to give you $2,000 an ounce because they're going to say, well, we got to make money. They're going to charge you for it. And if you try to buy it, they're not going to sell it to you for $2,000 an ounce. They're going to put what they call a spot. They have a spot fee. That's kind of like a commission. All right. So I checked into it a long time ago for some friends, and they were going to put $100,000 into a gold IRA. Well, you know what stopped them, especially when I found out about it? The people they were working with or looking at, and this may not be common. I'm just using this example because this is personal for some friends that I checked in with. They were going to charge them $10,000. So basically 10% of their $100,000 to invest in gold was going to be commission for the person that they dealt with. So they were going to put in $100,000, thinking they were going to get $100,000 worth of gold, but they weren't. They're going to pay $10,000 in commission and only get $90,000 worth of gold. How long would it have taken for that money for them to recoup that $10,000 in commission? So I don't believe, I don't have any problems with you buying gold, but I don't think it should be a top priority or a top investment. Remember, safe money investments is where you have to go. And you may look at gold and say, well, that's safe. I'm not saying it's not. But what you have to look at is if you pay $2,000 for an ounce of gold, the likelihood of you getting $2,000 for that ounce, if you turned around and tried to sell it immediately, is not going to happen. Okay. So those are some investments that I feel like that you need to avoid if you're getting close to or you're in retirement currently.